Hey everyone, Ryan Smith here, principal and founder of Think SBA and host of the My SBA Loan Pro podcast. Today I decided to sit down with Christian Graham, the host of the My SBA Loan Pro podcast studio. He asked me some questions about why I started Think SBA, how I started Think SBA, what I'm doing now, and what the outlook is for Think SBA and loan brokering in general. I hope you enjoy the show. So it all started in 2017 when I had a loan declined. This was in December of 2017. And what happened is I had a client I was working with here in town, and the loan absolutely should have been approved. But it was declined for compliance reasons. And I don't want to go into the details, but literally when I walked out of that room, I said, I need to start my own business. And over the next year on the weekends, I built my business model, I built my website. And my thought was at first, I want to be a jack of all trades, right? So my training is, I tell people, in holistic lending. So what does that mean? It means owner, user, it means investor, working capital, all of that, right? But during that year, I thought, I want to be different. So if I'm going to be different, I need to really niche down. And I heard a podcast that discussed when you're an expert, people chase you. You don't have to chase the business. And I had been familiar with SBA loans as I had originated them as a lender. And I thought, I love working with owners instead of investors. And if I were to focus on SBA lending, I would immediately differentiate myself in the marketplace. And the way that SBA brokers are paid is much better for the broker because I'm being paid 90% of the time by the bank and not by the borrower. So that's a much softer landing when all of these fees are flying around. They have that settlement statement. Again, 90% of the time, I'm not on it. So the example I give is there are a lot of brokers, again, who are the jack of all trade broker. But in SBA lending, you have the standard operating procedure manual. And that manual is about 400 pages that details all the rules and regulations surrounding an SBA loan. It's very complex, and most brokers don't understand the minutia and the minute complexity. But here's the thing. If you don't understand that, you could take borrowers down the wrong road and they can either lose the deal or lose money or both. So I tell people, imagine a NASCAR driver, right? Going and riding a go-kart. They're a master driver. That's going to be so simple for them. What I used to do inside of the bank was I would pre-flight my own loans, which means I would do my own analysis. Then I would present it to a manager or a credit committee. I sat on credit committee, so I have all of this experience dealing with various and complex lending transactions. Well, the SBA has the SOP, but once you understand that, the rest is easy. And the reason why the rest is easy is because all we're focusing on primarily is what I call the credibility of the borrower, and then the debt service coverage ratio, which means is the business, whether it's a real estate loan, a business acquisition, or a franchise startup, is the business able to pay back the loan and the business throughout the process? And that's all we're solving for. Much easier, much more focused. And then, as I tell people, SBA is my calling card into the broader community. Because the first thing, especially a lot of business owners do now, or acquisition entrepreneurs or franchisees, is they go to Google and they type in their long tail search query, and it usually involves SBA. Or they go to their trusted advisors and they use the word SBA. So the thought behind Think SBA is that when they're thinking SBA and they go to Google or they go to their trusted advisor, Think SBA is going to come up. And a lot of times what happens, in fact, the overwhelming majority of times, for example, I get a lot of my business through referrals of my trusted advisor network. They'll call me and say, hey, my client or my colleague or my friend, they said they need an SBA loan. And I said, that's not me. I don't know anything about it, but Ryan does. So there are service providers, then there are entrepreneurs, right? And usually there's a clear line that differentiates them or delineates them. So in my case, not only am I a business owner, a service provider, I'm also an acquisition entrepreneur. I bought a business last year. So imagine having a conversation with someone who isn't in your seat, as opposed to having that service provider also be a business owner, also be an acquisition entrepreneur, also being someone who's going to buy real estate, also being someone who's a franchisee. The conversation is completely different. Instead of it being, okay, I need these documents and I'm going to try to do this for you, which I do all that, right? That's my baseline. But then it's, like I had a conversation with a client on Friday talking about his interactions with his franchise. I helped him start a franchise in Southern California. And so we were able to talk about my interactions with my franchise, his interactions with his franchise. And if you're just a service provider and you've never been a franchisee, you're not going to be able to have that conversation. So my mission is to bring everything that I bring to the table, being an expert service provider over 20 years in banking, being a business owner. I stepped out and had the night sweats for the first couple weeks when the paycheck stopped coming in. And I even signed my own name on the dotted line for a $5 million SBA loan. So when people ask me, Ryan, I'm a little nervous about guaranteeing a loan of $1 million, $5 million, I say, you know what? I've had the conversation with myself. And this is how I came to the conclusion that I was comfortable signing my name. So I walked them through my process. I didn't do it willy-nilly, and no one else should. And then at the end of that conversation, I asked them, can you walk yourself through that thought process and come to the same conclusion that you're comfortable signing your name? Or maybe you're not comfortable. And guess what? If you're not, that's okay. You don't have to do this. No one's making you. So during the transition, the biggest challenge was maintaining my practice at Think SBA and transitioning the franchise. And so I went from focusing on my clients solely to, okay, now I have a 30,000 square foot building, so I'm dealing with a landlord. I'm also dealing with the franchise. It's one of the most successful family entertainment franchises in the country. I also now have 50 employees that I'm dealing with. And then on top of that, when we bought the Sky Zone here in San Diego, it was actually another franchise. So what we had to do is we had to dismantle all of the graphics, some of the attractions. And so we had to basically not bring it back to the studs. That would be an over-exaggeration. But we definitely were under construction for a long time. So I was at the location managing the contractors. And essentially we tore it down in a couple of days. And then it took several months to build it back up. The biggest challenge for me was having my best year at Think SBA while I was transitioning this business that I acquired. And as you can imagine, I now have the ability when someone tells me, hey, Ryan, I'm going to keep my job, but I'm going to buy this business. And I say, wow, that really sounded easy. It's not that easy.
Right.
Have you ever managed employees? Well, no. Okay. Well, have you ever interfaced with the municipalities when they send you these tax bills? No. And all of those different conversations I'm able to have. Now, what's nice about the transition is that now I spend an hour a week there. So I visit, I make sure that we're clean, I make sure that we're smiling, I make sure that our guests are being taken care of, and then I make sure that everything works inside of the park. That's my values. Those are my values, and those are the values I want for my employees who are going to be serving our guests. So that's what's nice about buying a business, even if you maintain your W-2 employment, or maybe you're maintaining your service provider, your independent service provider vocation or business, is that you will transition at some point where you're not there all the time. And because of technology, we can manage a lot of it through apps on our phone and on our computer. So I'm going to use this example. The difference between a Titanic and a speedboat. So we all know the Titanic story. There was an iceberg and it wasn't able to change direction quick enough and not hit the iceberg. Those are the major banks and even community banks. So people don't think about it because why should they? But large banks aren't able to pivot into the technology segment fast enough to meet where the consumer is. So that's the first thing. The second thing is that their processes, right? So they don't have the best technology. And then the second thing is their processes most of the time are disjointed. So those are two things, right? So the first one is they're not technically advanced. And then the second is their processes are slow and bureaucratic. So, okay, what does that mean for me? Well, I have a unique blend of having experience as a digital marketer and someone who understands software, but combining that with my 20 years in banking. So I'm set up to combine those so that I make the onboarding process much simpler and efficient. And how have I done that? Well, I've deployed the technology. Some of the banks are now catching up and they're deploying the same technology that I'm deploying. But what that technology does is it provides a quick and simple way for people to transfer their documents, which is the most difficult part of a loan application, is transferring the documents, right? And think about it. When people send documents, most of the time, in fact, I've never even had this happen, but they're not changing the name of the document. So for example, their CPA sends them a tax return. Whatever that name is, that's what you get. So you get 50, 100, 200 different naming conventions for all of these different documents. Well, one of the problems that the software that I deploy solves is I have a template. So I don't have to recreate the wheel every time. So when I drag a file, so for example, let's say it's a personal tax return for 2023. I drag it in, and guess what? It automatically renames it to 2023 personal tax return for the name of the person. And it does that for every document. So when the lender gets it, they don't need someone to go in, open up every document and give it a name. It already has the name. The second thing I do is I prepare a credit display, which outlines the who, what, where, why, how, when, and et cetera, so that when the lender actually receives the loan package, they don't just start reviewing the tax returns, personal financial statements, schedules of real estate, schedules of debt. All they have to do is go to my 2-page credit display, and they're going to see, okay, what's the purpose of the loan? Who are the borrowers? Who are the guarantors? Is there real estate? What are the strengths, the weaknesses? I highlight the weaknesses because I want someone to use a UFC euphemism. I want them to be able to tap out immediately if they see a weakness that says, I don't want to do that, because that speeds up the process. So right now I'm helping an individual here in San Diego acquire a business for $6 million. I sent the credit display to this lender. He has $8 million credit authority. He sent me an email. He said, Ryan, because of your credit display, I know I want to do the deal, and you'll have a contingent commitment letter within the next 3 days. That's insane. And I was able to show my borrower, hey, just in case you were wondering, why am I working with Ryan? This is one of the reasons you work with me, is because I understand what the lender needs, because I was a former lender, and I'm able to provide that to them so they can make a quick decision. Here's what it will, like a lot of industries, AI will enhance and accentuate what I do. So for example, the software that I deploy, what they should do is they should just add a new piece of software, whatever you want to call it, inside the software that I already have. And it should recognize the profit and loss statements, the balance sheets, the tax returns. It should recognize the personal financial statement. It should just recognize all those documents, and it should extract the data and create the credit display for me. And then all I have to do is review it and confirm what it has given as results. Now, there's already a software out there. I was speaking with an individual, and they're about 60% of the way there. They've actually solved the harder problems, and they will be based on what I share with them, because I gave them my expert insider recommendation. Hey, if you do this, this, and this is a showstopper. Like, this is going to, and I'll say it, you know what? This type of software will allow people, like you hear a lot of with AI, not to reduce the workforce, but to redeploy the workforce so their employees within their organization to do things that make more money. Because now you have AI so for example, I have an assistant and she's fantastic. And what she does is she does most of the credit display, the analysis. Well, if AI takes that over, now I can redeploy her into activities that generate income for the company. So this has changed over the years. So when interest rates were low, you can imagine real estate was on fire. So at that point, it was probably 80-20 real estate to business acquisition and franchise startup. Well, then rates increased. So the real estate volume decreased. Well, enter business acquisition. So as many people know and are talking about, the baby boomer generation is now transitioning to retirement, which means they're transferring their businesses to the younger generation, kind of like me. And so now it's about 60-40 business acquisition, franchise startup, and then real estate. So real estate has not gone extinct, but business acquisition has really taken over the limelight of the most types of transactions that I'm doing. So the first thing is and what I do is I differentiate by combining, right? So I combine various disciplines and expertise. For example, I'm a former banker. So I always tell people, when you talk to me for the first time, I'm your banker. But guess what? I work with every bank. I work with every relevant bank to your transaction. And the way I couch that is coast to coast, border to border, Main Street to Wall Street. I work with banks you see on every corner and banks you've never heard of, but my clients are always going to get fitted with the right bank. So they're talking with a banker. What does that mean? It means that I'm not someone, like a lot of my competitors, who don't recognize what they have. Let me explain that. So when someone submits a package to me, the first thing they want to know is, how long before I know whether or not I have a deal? And I'll tell them 24 to 48 hours. They say, why is that, Ryan? Because I was working directly with a bank and they told me 2 to 3 weeks. And I said, here's why. They have to send that loan package to an underwriter, and that underwriter has a pipeline. So your loan sits in that queue for days and weeks, and then they underwrite it in 1 to 2 days. Well, guess what? You send it to me, my assistant and I, we collaborate, and we're going to underwrite that in 1 to 2 days. Remember, we're the speedboat. We're not Titanic. We're very nimble. And because of my training, I know exactly what I have. So that means, for example, if it's a business acquisition, real estate, or a franchise startup, I know where that needs to go. My brand, meaning the lender. My brand promise is that my clients will receive the lowest interest rate and best terms for which they qualify. A lot of times I volley that back to people who have gone through the loan process, because there's a lot of DIYers out there. They think, oh, I'll save money, I won't use a broker. Then I ask them the question, did you get the best deal that you qualified for? So that means, did you scrub the entire database of lenders that are relevant for your transaction throughout the United States? Well, I mean, they, of course, they're going to say no. They're happy they got a loan. Well, what if you go to a lender, not asking the lender, what can you do for me? But going to the lender and saying, hey, I know what I've got. This is what you are going to do for me. And if you don't, I'm going to go over here. And now, being a former lender, I treat my lenders with the utmost respect. So here's my marching orders to my lenders as we collaborate. I want your best. I know what I have. You're not going to tell me, oh, you have a bad deal, highest interest rate, pay the most points, Ryan, I'll make the most over here. No. It's lowest and best. I know I have a good deal, so I need your most competitive offer. And they know that if they do give it and they are the best, then we'll move forward with them. They also know that if they're not, I'm not going to drag them on forever. I'll say, okay, boom, tapped out. You're not the lowest and best. And then we move on. What happens is they get a good credit display. They review it quickly. They know what they have. I know what they have. And then they'll say, yes, I want that loan. Here you go, Ryan. Here's a term sheet, lowest and best we can do. And again, it speeds everything up. It makes the transaction not only faster, but more seamless in the beginning. And then the borrower gets really what they want is this, that 99.9, I say, look, I'm not the approver. I cannot say 100%, but 99.9%, this is what we have. This is what you can expect. And we will close this loan 99.9999%.
Yeah.
Unless we find out something that we didn't know about you later and there's a reason to decline it. But what I see here is this, explaining the definition, and then we move on. So what I look for is really simple. And, most lenders would say that they're looking for this, but for me specifically, it's credibility. So what does that mean? It means that when a person gets on the phone with an underwriter, they can speak intelligently about the business, whether it's their business or a business they're buying or the franchise, and they can speak intelligently about all the aspects of the business. So the customers, the vendors, the sales, the marketing, all of those different types of things. Now, the most difficult types of loans would be projection-based loans. So again, typically, the SBA is going to finance businesses or real estate purchases where there are what's called historical cash flow. You can look back historically, last year, second year, third year, and the business can pay the loan back and pay themselves as well. So, right? The ones that are most difficult are those that are based on projections, meaning there is no historical income. I'm working with a gentleman right now. He wants to buy a closed hospitality property. There's no income. It's going to be very difficult. There were some things I liked about him from a credibility perspective, but ultimately it's going to be difficult. And then to stack on top of that, it's difficult when people have had bankruptcies. It's not impossible, but it is difficult. It's also difficult when someone's buying a business and they have no expertise in that business and they have what's called no transferable experience into that business. Lenders are shying away from that in the acquisition entrepreneur space right now. So those are also deals that are difficult. And then I want to talk about specifically a type of borrower that I'm seeing. They're younger. They haven't amassed a net worth yet of moderate significance. We don't need you to be a millionaire, but you know what? Maybe a couple 100,000 nest egg that you have saved in a savings account or your checking account. Maybe it's a high yield savings, and then some retirement. So I would say the most difficult would be those who are maybe early, mid, late 20s. They're just getting traction. The sweet spot's really when they're in their 30s and they have amassed a little bit of net worth that we can say, hey, look, what I say is, hey, they're grown-ups. They've been battle tested. They put some money away and they're able to manage their own finances. And that translates to being able to manage a business. So the first thing we would do is we would assess the cash flow of your existing business. So, right, for example, if you said, hey, I want to buy a building and have a podcast studio and I want to have a co-working space, and I would say, okay. And I just did this, by the way, for a gym in Colorado. So they were a small gym they were leasing. And they came to me and they said, Ryan, we want to be a big gym and we want to increase our revenue 10x. And instead of just having people come and work out, we want to service, for example, professional athletes. And we want to serve travel athletes, for example, soccer, baseball, right? And we want to make this a place where people from all walks of athletic life can come. So they had a smaller business and they were transitioning to a bigger business within the same business model. And so what I said was, okay, we looked at their ability to service the debt historically, and it wasn't there. So this goes back to being projection-based. But the person was credible. Why? Well, because this person was an expert in what they wanted to build. And they had demonstrated that through successfully operating their gym. So what we were able to do is obtain a $6.5 million loan to buy and build out a facility that took them from a gym where people went and worked out to now an all-encompassing essentially athletic warehouse with all these different revenue streams and disciplines within that same business. And they had been turned down. They went to their local bank and they were turned down. They came to me and we had to sort of rescue the deal. Now, in your case, if you say, hey, Ryan, I want to go from this business, I would say, do we have historical debt service cash flow? The answer is no, but you're expanding within your discipline, right? And you have the liquidity to inject on the property and you have projections, and these projections aren't based on only a dream, but they're based on trends, not only in your business, but macro level trends. For example, this particular type of industry is booming and you're specifically positioned to take advantage of that. And this loan will allow you to do it, and you have an amazing business plan and you have projections, then that's something that can be done and I have done in the past. And, I look at, like you said, right? So I look at a person's credit score. I look at their personal liquidity. I look at the cash flow of the business, and I look at what I call credibility. It's really simple when you're working with someone in a space that wants to grow into that space, but in a larger way. Because the banks look at that person and say, yeah, they're credible. And then their business plan isn't, I'm going to go from one location to 15 in a year. It's, I'm going to expand, but I'm going to expand within reason. So the way we match them, as I have shared before, is we assess their credit score, the cash flow, their personal liquidity, and their credibility. So we look at all of those factors, and we work with what I call every color of the rainbow. So lenders are different. There's some lenders that are really low interest rate, but then their credit box, because of that, right, is tight, meaning very few borrowers fit into their credit box. Well, then on the other end of the spectrum, you have lenders who have a much wider credit box, and we don't need the deal factors and the characteristics to be as good, but it's still a good transaction. So for example, I might work with someone who has an 800 credit score, several $100,000 stocked away, and they're buying a business. Well, the business is a little bit of a wreck. But I had this happen where a bank that's very tight, low interest rate, they said, we're going to lend this person the money because we like this person so much. And even though the business has a concentration with one particular customer, we're going to mitigate that and overlook that because of this particular individual, right? So I was able to match them with a low interest rate lender, even though there were problems with the business. Now, conversely, you can have somebody, which I have this too, where I just closed a loan for someone who has a business in San Diego and they bought another similar business on the East Coast. Well, the business owner, like a lot of them do, wanted max value for the business. So I'm talking highest possible value with the lowest possible debt service. That was a very strained deal. The borrower had very little liquidity because they owned a manufacturing business here. And what they did was they deployed, like a lot of business owners, right? They deployed their liquid capital back into their business. So we have max value, we have very low debt service coverage ratio, and we have very low liquidity. But we had a person who was managing and owning a business here and buying a like business, a complementary business somewhere else. So I wasn't able to go to a low interest rate lender because the transaction was bursting at the seams. Like everything was stretched, everything was maxed. So I went to a higher interest rate lender who was able to close the loan. And I had someone ask me the other day, Ryan, why would I go to a higher interest rate lender? And here's what I said. Because the highest interest rate lender or a high interest rate lender is still less than equity. So less than bringing in equity partners over the long haul. And if it's a good business and a good deal, you will still make money even though you have a higher interest rate. So in this case, this individual bought the business with a higher interest rate because they're going to make a lot of money. And then guess what? The interest rate may come down, and we've already seen the interest rate come down since I closed that several months ago. But then the individual can then also refinance later. And this is a key word here, once they have stabilized the business. So I can't emphasize enough, whether you're starting a business or buying a business, the first 2 years are critical, and the banks know that, and they view your loan like that. After a person has stabilized a business for 2 years and demonstrated their ability to what I call transition and stabilize the business, then the whole world opens up. So the biggest misconceptions they have are that those loan programs are only for risky borrowers. It's absolutely not the case. In fact, some of my best borrowers choose to buy a business with an SBA loan because conventional options are not necessarily realistic, number one. And then number two, they purchase real estate also with an SBA 7A or 504 because they're able to leverage up the purchase from a loan to value perspective higher than a conventional loan. And in layman's terms, that just means they get to keep more of their money, whether it's for working capital or just dry powder. So those are the biggest misconception, is that it's for low quality borrowers. And then the other misconceptions really have to do with the standard operating procedure manual, because again, everyone's a keyboard warrior. So I'll get people who will call me and they'll say, I was Googling this. And Google will give you results. When you ask questions to Google, it'll give you results sometimes that are answers from 2 to 3 years ago. And there's been a lot of change within the SBA loan program. So those misconceptions are outdated. Well, what they think is right is a misconception now because it's outdated. The rules have changed. So let's talk about conventional and SBA, right? So conventional would be your regional or your community bank. What most of those lenders are doing, right? So not the big banks, but the banks that you see in your community, and you might notice them, you might not. What they're doing right now is they're playing it safe. So they need to hit certain depository benchmarks, so they have to have liquidity. And by playing it safe, they're lending to their portfolio. And then they're being very picky on who they allow into their portfolio. So what that means is, I'm not going to say this across the board, and I don't want anyone to think I have a bad taste in my mouth, but right now, the small business borrower, the true small business borrower, who wants to buy a building for, let's say, $1 million, or they want a working capital line of credit, they're really not going to be serviced that well by that local bank that literally used to exist for them. Because of the way regulation has changed, because how they have to preserve capital, and how it's easier to manage their portfolio of known commodities. And I don't blame them, right? I mean, hey, if you know a borrower is good and you can go deeper with that borrower, whether a larger depository relationship or lending relationship, that's a good strategic move. So what does that mean then? It means that we shift over to the SBA, where those lenders now are going to be more aggressive. And they're going to be aggressive, but they're going to be aggressive when a business is growing through acquisition, so they're acquiring a business. They'll be aggressive when a business purchases real estate using the SBA loan program. Primarily banks prefer the 504 because it's a 50-40-10 partnership. The bank does 50%, so they do a first trust deed at 50% of the purchase price or the total cost of the purchase and build out. Then the SBA, the CDC, Certified Development Company, they do 40, and then the borrower 10. So the bank has the ability then to have a 50% exposure instead of 90 or 85 or even 80 if they're doing a conventional loan. So that's why they like that. The 7A, some banks specialize in it. What I mean specialize, I mean they have a extremely low interest rate, and the 7A is one loan, but it's guaranteed by the SBA up to 75%. Some of the lenders out there, especially larger lenders, the smaller lenders don't like the 7A for real estate. They like the 504 for real estate. But there's some larger lenders out there who have a 7A. I call it the silver bullet 7A. Here's why. It's a low interest rate. So, for example, I had a 7A this year. I closed at 5.5%. fully amortizing, which means they never have to refinance that loan like a conventional. Those typically have 5 or 10 year balloons. And the 7A only has a 3-year prepayment penalty. So if rates were to dramatically drop, then that individual could refinance after 3 years without penalty. The 504 has a 5 or 10 year prepayment penalty structure on the first, and then a 10-year prepayment penalty structure on the second.
And these usually last about 20 years, correct?
So the amortization is 20 or 25. Most of them are 25.
Got it.
And there are a few lenders out there that will do 20 years as a preferred amortization. So if it's to buy real estate, the reason is if you get a 504, for example, imagine being able to buy a $2 million building with $200,000. That's a good return, especially if you can bring in a tenant, because you only have to occupy 51%. So if you brought in a tenant, you deploy $200,000 toward a $2 million asset with a tenant, which means you're generating income, and you get to hold that asset for the next 20 or so odd years. And at some point, you'll own that asset free and clear. When you do the math on deploying $200,000 for $2 million, $2 million, that turns into maybe $3 million or $3.5 million. That's a fantastic deal, right? So that's the first thing. Now, what if you're not talking about buying real estate? What if you're talking about growing your company, getting working capital? So there's 2 different types of working capital. There are lines of credit. You just want to go to your bank for that, but that is so a line of credit is for short-term needs. You need to pay employees. You need to keep the lights on. You don't get paid for 60, 90, 120 days from your customers, right? That's short-term working capital. Those are lines of credit, and you can go get those from banks. Typically, banks will give up to $100,000 without placing a lien on the business or without a UCC filing. Now, the SBA is different. So, for example, if you wanted to grow, you said, you know what, I want about $100,000, $200,000 because I want to buy more equipment that'll allow me to open up revenue streams and now be able to make more money. Well, that's not a short-term need. That's a capital need. And what the SBA is going to do is they're going to give you 10 years to pay that back, which is amazing. So you get a $200,000 loan. You buy your equipment now. You deploy that equipment. You start earning revenue right now, but you don't have to pay that back except for after over 10-year period. But you can also pay it back without penalty anytime. So why would you do that as opposed to a VC and angel? It really depends on what your goals are. Do you want to skyrocket like Jack and the Beanstalk, or would you rather grow incrementally and have a firm foundation and then be able to stack once you built up your own liquidity? Are you willing to give up ownership in your business? If you are, you go the equity investor route. If you like to preserve that capital, then you go the SBA route. Again, a loan is always going to be less expensive than someone who is going to have ownership or a say in your business. Plus, as long as you pay the loan back, the SBA is never going to come to you and say, well, why did you make that decision as a business owner? When you have an equity investor, they may be on your board, they may be calling you, they may be asking you, why did you have a down year? Am I going to get a distribution? All of those types of things. So again, information for the person either buying a building or who needs tenant improvements, furniture, fixture, equipment. Information is power. So that's going to give you the ability to make the right decisions. So my process, going back to technology, I have a pre-qualification process, much like people would be pre-qualified to buy their primary residence or a home. I can pre-qualify them for an SBA loan. And again, there aren't many brokers who can do that because they don't have the experience as a banker. So you send me the documents I need. I call it the path of least resistance. I don't want to send you a 40 document laundry list. I know exactly what I need. I send it to you. You give it to me. Then we have a conversation. How much money do you want? What are the use of proceeds? You tell me all of that. And then I'll tell you, you can cash flow this historically. You can move forward and you can either lease a building for this much, or you can perform this much tenant improvements. You can perform this much in, acquiring furniture, fixture, and equipment. Or if you want to purchase, this is how much you can purchase. In addition, if you want to purchase, there are what called rent replacement loans. Now, this is powerful. I'm helping a company do that right now here in San Diego. Rent replacement. What does that mean? So, for example, you lease this space. So you could buy a building under the rent replacement provision in the SBA SOP, and as long as the loan cash flows, so we have to cash flow historically, that's the only difficulty possibly, you will inject zero equity injection and preserve your capital. That's very powerful. So what that gives you the ability to do is say, okay, we wanted to buy, for example, a $2 million building. But you know what? We can satisfy what we need with a $1 million building. I'd rather buy a $1 million building with zero capital deployed, expand my business. Well, guess what you have? You have all that capital. So if you expand your business, if you stabilize your growth initiative, well, you just kept your capital. You're making more capital. So guess what you can do now? Now you have options. Maybe you go buy another building because you haven't deployed the capital, and now you keep this building, and maybe you rent out 49% of your current building, you move in a new building. So there are extremely powerful ways to utilize the SBA loan program when purchasing real estate that a lot of people don't know about. In my business, I always tell people I don't have to call anyone to get business. So I don't do that. As you can imagine, everyone wants a loan, right? I mean, if people have a vision and a dream and they don't have the capital, they either need, like you said, an equity partner or they need a loan. So I have new opportunities coming to me like a fire hose. So, but I'm also one individual. And what I've decided for myself is that more isn't necessarily better. So the culture internally includes not only my assistant, but it also includes my lenders and my third-party service providers, people that are required a lot of times to get a transaction done, whether that's bookkeepers, CPAs, insurance providers, all of those things, right? So the culture is this. Our focus, number one, is the client outcome. And you might say, duh. No, not duh. Because most of the time, the first conversation a broker has with the lender isn't what can you do for my client? It's what can you do for me? How many points can you give me? I want to get 2 points. I want to get 3. And so that's the primary conversation. Well, that's not my culture. So I differentiate myself very simply by saying when I have that first conversation with a lender, or for example, when it's a third-party service provider, whether it's my assistant, my lender, they all know, hey, we're in this for the actual borrower's outcome. This is an actual conversation. 1 week ago, I sent a deal to a lender. Hey, Ryan, if we can charge prime plus 2.5, I can pay you 1.25. That means I would get 1.25% of the principal loan balance. And I said, that's great, but what's the best you can do? And they said, well, this is the best I can do and pay you 1%. Well, okay, that's fair. That's my industry target. And so I got a better interest rate for my client. So that's my culture. And everyone that I work with has to understand that's my culture. So we are focused on the borrower. Now, my goal every year is to do 25 loans for $50 million in volume. So that means I average $2 million a loan, which I do now. Started off at around $700,000, grew to $1 million. So now the average deal size, the average loan size is $2 million. So as an individual with an assistant doing $50 million, 25 loans per year, I'm able to be active, engaged, and go deep with my clients as the banker, then the broker, but then the most important part I always tell them is the advisor. So I'm advising them through the whole process. And the reason that's important is because as someone who's done this over and over and over again, from beginning to end, I have more experience at every facet of the process than the bank does. Because the packager's never been a closer. And they don't talk to each other. So there are certain things that must happen before a loan closes that the bank isn't going to tell them until they get to that place in the conveyor belt, right? In the process. But I tell them that from day one. So for example, life insurance, most loans at the SBA level require life insurance. The lender's not going to tell you that. They're not going to mention that until you have a formal approval and they have the closing checklist call. That could take 3 to 5 weeks puts a lot of strain on a business acquisition, puts a lot of strain on a real estate purchase. And now that borrower has a heightened anxiety because they have to go through, and people laugh, but yeah, you have to draw blood to get an SBA loan. You have to have an exam. So that's what I'm able to do from a culture perspective. Now, some people say, why don't you just go big, like have a huge agency? Well, you know, I have the benefit of living in San Diego, California, which means I want a life. And remember, it's not what you make, it's what you keep. And I know if I 2X'd, I would keep less, have to 3, 4X. But then I have the benefit of knowing people who are in their 60s and 70s. They built large agencies, and after 20 or 30 years, not all, but a lot of them have commented, you know, my marriage was either in shambles or not where I wanted it to be. My relationship with my children was either in shambles or not where I wanted it to be. I was stressed out. My health suffered. So bigger is not always better. And I think if you're really big and you can step away and you have people in place to manage the day-to-day, that's great. But it's that in between, it's getting there. And is that really worth, number one, your customers suffering, but then your family suffering, you suffering? Because ultimately, none of that matters. If you don't have your family, your health, what do you really have? We're never going to really remember the money over a certain point, right? So those are my values, my culture. Service 25 people, 50 million a year, high quality service, and everybody wins. So this is just two types. The first type, I would call ultra wealthy. And I'm going to define that. This isn't necessarily ultra wealthy. I'm talking about billionaires, but people who have enough money. So let's say they're looking at a loan of between 2 to 5 million, but they have 10 to 15 or 20 million liquid, meaning they have it liquid. They could go write a check right now. Typically what happens is they get tired of the SBA loan process and they'd rather write a check. So that's the first type of borrower that doesn't get to the finish line. They just get exhausted. I don't want to fill this paperwork out. I'm going to tap out. Okay. The second type are the smaller deals. And well, why is that? Well, the smaller the deal, the more that's on the line, and usually the more heightened anxiety a person has, because even though it's a smaller deal, it's a bigger deal to them. The numbers are bigger to them. They've never taken on $300,000 or $400,000 in debt, maybe to buy their house, but never for a business. And there's just so much anxiety. There's not a ton of sophistication either, because they've never been in the crucible before. And ultimately what happens is they misstep or they get overwhelmed and the loan doesn't close. So those are the two types. Either side of the spectrum. People that have so much money, they just tap out because they get frustrated with the process. And those people who on the lower end don't have as much to lose. They have 50,000. They're thinking, wow, well, man, if I lose 300,000, that means my 50's gone and now I'm starting from ground zero. So typically those don't go through either. So what I've seen since COVID, so when I started in 2019, I was the first to start an SBA focused serial podcast. Not the first to have a podcast about SBA lending, but the first to start a serial podcast. Now, there were a couple of others who came online, ironically, only a few months after me, but then COVID hit. And banks started to change their mind and their policies on enabling their business development officers and relationship managers to market. So when I started, it was basically me and a couple of other voices. Well, now everyone has a voice, whether it's because of their phone or they're putting $2,000 into high-tech video and audio equipment. And I'm fortunate in that I started my business at a time that Google and AI recognize my authority. So what that means is, as far as where is the industry going to go? The first thing we've talked about it, AI is going to do a lot of the analysis so we can redeploy our human resource talent, our employees, to do revenue generating activities. But also more and more, lenders, relationship managers, business development officers are going to have a voice. But also, people who don't have any expertise at all are going to have a voice. And that's happening now. So there's people on TikTok. I have a lender. He said, Ryan, this guy on TikTok, he doesn't have any clue about what I do, but he realized that I'd pay him money if he sends me referrals. So this guy creates videos on TikTok. People contact him. He matches them with a lender. And again, he's not their banker, their broker, their advisor. He's zero. He's zilch nada. He'll get the same paycheck or commission I will. So there's going to be a crowded room. The more we get away from COVID, the more banks make their policies more lenient in terms of social media, and the more people that we're seeing who are influencers understanding that being an SBA-focused loan broker or referring loans to lenders is economically viable for them. So it's important for me to stay, which is why I rent this space and am publishing 45 to 60 minute podcasts every other week and creating the reels. Because if I'm not there, I will be overtaken. I will be swallowed up. But that's why I do this. I want to do this for the next 20, 30 years. I never want to retire. Maybe I'll transition it to somebody someday, but I'll still keep my hands on it. So that's where I need to be. I need to be here. I need to be interviewing people. I need to be bringing value. I need to have the reels. I need to have the long form content, all of it.